Hi everybody, Griffin Bridgers here. This is going to be the first in a series of videos on some of the new tax law updates. And really what we're going to start off with today is kind of working backwards through some income tax changes we have. But because this serves as a good aggregator for a lot of the other new updates under the One Big Beautiful Bill Act. We're going to start with itemized deduction limitations under Code Section 68. Now, before we get started, the usual disclaimers apply that this is not intended to substitute for legal or tax advice. This is educational content, and importantly, audience wise, it is intended for wealth transfer professionals. So I routinely get comments from and emails from people, oh, this wasn't useful. It didn't help me with my tax return or anything. It's because you're not my target audience. I'm looking to educate professionals. So this isn't intended to substitute for guidance from your CPA or to be a do-it-yourself guide or resource. Now, that being said, if you are a wealth transfer professional and you'd like to support my efforts to bring you this type of education, one of the best ways you can support me and also get further education, through the written word is through subscribing to my Substack newsletter, State of Estates, which you can find at griffinbridgers.substack.com. And throughout this, there's some hypotheticals and some examples you use. I can't guarantee the accuracy of the information or examples in this presentation. So that brings us to the general change. Effective starting in 2026, individuals and, as we'll talk about later, estates and non-grantor trusts will not be able to fully deduct all of their itemized deductions. Under OBBBA, Code Section 68 has essentially been restated, and the prior P's limitation on itemized deductions has been replaced, which was not even in force for the last several years due to the Tax Cuts and Jobs Act. But now we're back to a new set of limitations on itemized deductions. Now, beyond this, a lot of the itemized deductions, some old, some updated, have their own specific limitations and reductions. Big ones are, for example, the deduction for state and local taxes, which was capped at $10,000 under the Tax Cuts and Jobs Act, has now been increased to as much as 40,000, but with a phase down starting once you hit 500,000 in income starting in I believe this year. But there's also a new charitable deduction floor you have to exceed as well. All of those types of deduction specific reductions apply first. And then once you've determined your tentative itemized deductions, you then get into this specific limitation. So what does this limitation apply to? Well, really it looks at 2/37ths of the lesser of two amounts. One is your total tentative itemized deductions, which, like I just said, is after deduction specific reductions, but before this actual limitation. So we're really looking at what our pending itemized deductions might be and figuring out what amount of those get reduced. However, if less than your total itemized deductions, you also have to take your tentative taxable income, but increased by the itemized deductions, and determine how much that amount exceeds the dollar amount at which the 37% rate bracket kicks in. So those are our two amounts. We'll kind of look at some examples later on. Now, on that second bullet point, as we shoehorn into the examples, I think an important point is that the words of the statute say taxable income increased by itemized deductions. Some of you may be asking, isn't that AGI? Isn't that adjusted gross income? Not quite, because there are several things that factor in, especially under the new law. After you determine your AGI that are deductions available for non-itemizers that you still have to subtract. And those come out before getting to this quote unquote tentative taxable income number that we're going to use to determine how much our bracket is exceeded by at the 37% point. Now, we can look at examples, but keep in mind that this doesn't kick in until 2026. At the time of recording this video, we don't know what the inflation adjustments are going to be going into next year for the various brackets. So I'll come up with some hypothetical numbers in the examples, but by no means are they intended to be accurate. So this year for joint filers, The 37% bracket kicks in at 751,600. Once you're over that, that's where the 37% bracket applies. For single filers, 626,350. And then for estates and trusts, 15,650. So, one of the interesting changes in OBBA is that the text of the code section 68, both under current law and under new law, states that this itemized deduction limitation only applies to individuals. Now, it doesn't say only, it just says individuals, which reading between the lines would tell you, okay, estates and trusts usually shouldn't be included in that category, but for some rules in the laws of taxation for trusts and estates that say that they're generally going to be taxed the same as an individual, but with certain tweaks under Code Section 642. We won't get into all that, but one interesting outcome under OBBA is that under current law, there's a Code Section 68E that excludes estates and trusts from the current P's limitation. However, in the new law, remember how we described that as a restatement of Code Section 68? That carve out accepting estates and trusts is no longer there. So initially, a lot of people read that and thought, okay, was that accidental or did they actually intend to apply this to estates and trusts? There was a Senate Finance Committee summary that came out of the OBBA provisions, and that confirmed that the omission was intentional and that estates and trusts will also be subject to this limitation on itemized deductions. So with that backdrop, let's look at a couple examples. So again, spitballing, can't guarantee all of these examples will be accurate, but really we're using these to illustrate the general principles of what's going on here. So we're going to assume in 2026, when this kicks in, that our 37% bracket for joint filers will be $775,000. Now, it's not intended to be an accurate forecast, but we have in question this hypothetical couple, Jack and Jill, who have $1,050,000 in tentative taxable income after applying all of their other deductions for non-itemizers. Those are all listed out in Code Section 63B. We'll touch on those a little bit later, but a big one, for example, is the deduction under Code Section 199 Cap A for qualified business income. So we take that amount, and that's before subtracting our tentative itemized deductions of 75,000. So if all of their itemized deductions were allowed, their taxable income would be $975,000. But that's not going to be the case under the new law because we have to apply this limitation. So we're going to start first with the amount by which their taxable income before subtracting the itemized deductions exceeds that 37% rate bracket. And that amount is going to be $275,000 when we subtract the beginning of that bracket, $775,000, from their tentative taxable income with all their deductions added back in. Keep in mind, again, that's deductions after all of the deduction specific limitations and reductions. So we're going to assume those have already been applied. But we have to compare that and figure out if which is the lesser of those two amounts, that 275,000 excess or the total tentative itemized deductions themselves. And that amount of itemized deductions, 75,000, is less. So that is the amount to which we'll apply that 2/37 reduction. So 2/37 of 75,000 is going to be $4,054. So when we subtract that from our itemized deductions, that's going to give us 70,946 in itemized deductions that can actually be allowed and applied after that limitation. So that's going to result in Jack and Jill having taxable income of $979,054. In other words, remember on the first slide where we talked about how tentatively they could have had 975,000 in taxable income if that limitation had not applied. Well, this is the classic example where the amount of deductions that were not allowed was $4,054, which we're adding back in to that 975,000 figure. So we see that here. Again, I want to remind you that the itemized deduction amount we're taking is after all the item specific reductions to that amount, and then also Remember that reduction between the lesser of these two amounts is applied to the itemized deductions themselves in determining taxable income. We'll take another example, kind of simplified, maybe not exactly completely accurate, but spitballing for purposes of this illustration. For one big planning scenario I see being affected by this, so we're going to assume in 2026, again, not intended to be an accurate forecast, that the 37% rate bracket for estates and trusts will kick in at 16,400. So we have Jack, not the same Jack as before, but Jack who has died in 2026, and his estate is the beneficiary of his $1 million IRA. Jack also had a taxable estate, so that IRA generated 400,000 in federal estate tax, but we're going to assume Jack's an estate that doesn't impose income taxes on estates or even its own estate death or inheritance taxes. So Jack's estate is going to just take the money and run. They're not going to wait the 5 years. They're going to just take one big lump sum from the IRA in his year of death. That's going to result in $1 million in taxable income to his estate. So now we get into this weird world where what exactly is defined as a trust itemized deduction? There's been some breadcrumbs here and there. We'll talk about maybe where you can find that source, and more of it is going to be what's not an itemized deduction versus what is, because it's really going to be dependent on the definitions that apply to individuals. So I have a good Substack article on that. I'd encourage you to check out my newsletter on that piece. But with that estate tax that's generated by the IRA under Code Section 691C, Jack's estate is going to get a deduction of 400,000 against the IRA lump sum distribution it is taking. So, assuming that there's no other deductions that would otherwise reduce the taxable income of the estate in arriving at AGI, or even looking at the code section 63B permissible deductions, or under 67E, its own set for estates and trusts, which may have some application beyond just code section 67. We'll see that really the only thing we might subtract other than that would be the personal exemption available to estates of $600 under code section 642B. So we're going to assume that's the case. There's no other deductions. There's no QBI. There's nothing that could get further reduced out of that million in taxable income. So we start here, where the estate's tentative taxable income with the unreduced itemized deductions added back in exceeds the 37% bracket starting point by 983,000. So our tentative itemized deductions before the reduction is going to be 400,000. So again, we have our itemized deductions being the lesser of the two amounts, or tentative itemized deductions being the lesser of those amounts. So 2/37 of that itemized deduction amount is going to be 21,622. So of our 400,000 in itemized deductions for Jack's estate, only $378,378 can be deducted by the estate after applying that limitation. So ultimately, this means the estate's taxable income comes out to $621,022. So again, there might be some flaws in that calculation, but either way, that's intended to be a high-level illustration of how this might work for estates. So a few things to keep in mind is that we often think of deductions as being in two categories. We have deductions used in arriving at AGI, and then from there you can elect to take standard deduction for individuals or itemized deductions. But there's still a set of quote unquote deductions under Code Section 63B that still get subtracted from AGI before computing the amount by which the tentative taxable income with itemized deductions added back in exceeds the 37% rate bracket start point. So all of these are allowed regardless of whether or not you itemize. Now, I put personal exemptions here. Individuals can no longer take those. Those are only available for estates and trusts under Code Section 642B. We also have the deduction for qualified business income under Code Section 199 Cap A. That was made permanent in the new law under OBBBA. And in addition, under OBBBA, we have some new deductions that are given that weight. They're in this new third category that you can take this beyond AGI, but before getting into your itemized deductions. In other words, these are all available for non-itemizers or even for itemizers, regardless of what election you make. Those include deductions for certain qualified tips, qualified overtime compensation, and then up to a point, qualified passenger vehicle loan interest. There's also a charitable deduction available for non-itemizers under Code Section 170P, which kicks in here. That was 300 or 600 joint for this year, 2025, and prior years, I think back to 2021. But that amount has been increased to 1,000 or 2,000 for joint filers for 2026 and beyond, I think with inflation adjustments applying as well. Don't quote me on that. I'm not sure about the inflation adjustments. I need to kick that or check that. But a couple other points here. While this applies to estates and trusts, I think it's important to note one, there's a lot of trusts out there that might be fully or partially grantor trusts. If that's the case, that part of the trust that's deemed owned by an individual, whether it's the grantor or beneficiary, is going to have its own income and its own deductions allocable to that income reported on that individual's tax return. So the calculation will be separate for those deductions as opposed to the trust. Or there may be no calculation for the grantor trust at all if it's a wholly grantor trust. And one of the biggest areas of clarity we're still not fully 100% sure on is that instead of a charitable deduction under Code Section 170, states and trusts get their own separate charitable deduction under Code Section 642C if certain requirements are met. We won't get into those requirements, but it's not yet clear whether that deduction itself might be treated as an itemized deduction at the trust level. Still a possibility, but that remains to be seen. But again, I thank you for joining me for this presentation. If you'd like more education like this and deeper dives, I'd encourage you to check out my newsletter, griffinbritters.substack.com.